Differences between opening balance, closing balance and trial balance. Opening balance versus closing balance versus trial balance. Opening balance is the balance of an account at the start of an accounting period, whereas closing balance is the amount remaining in an account at the end of an accounting period. For example, a month or year. Whereas trial balance is a statement that lists all the ledger accounts along with their respective debit and credit balances to ensure that the accounting equation, assets is equal to liabilities plus equity, remains balanced. The purpose of the opening balance is to make sure the bank balance shown in accounting start matches the balance in your actual bank account. Whereas, the purpose of closing balance is the indication of whether a business may be spending too much or not earning enough. If you end the month with a negative closing balance, you know something needs to change. Whereas, the purpose of trial balance is to act as a tool for verifying the mathematical accuracy of the ledger by summarizing the balances of all accounts. It helps in detecting errors and ensuring that debits equal credits. Opening balance is also called as beginning balance, whereas closing balance is also called as ending balance. Whereas, trail balance is also called as bookkeeping worksheet. Opening balance in accounting usually used by the abbreviation B by D for brought down or B by F for brought forward alongside your opening balance, referring to the fact that your opening balance is a figure brought forward from the previous accounting period. Whereas, closing balance in accounting usually used by the abbreviations C by D for carried down or C by F for carried forward alongside your closing balance, referring to the fact that the figure will be carried forward to the next accounting period. Whereas, trial balance is primarily used for internal verification purposes to ensure the accuracy of the ledger balances and identify any errors before preparing financial statements. When you start a new business, your opening balances are zero, unless you spent money before setting it up. Money from investors or lenders will be entered as transactions during the accounting period. Whereas, closing balance of an accounting period can be found by calculating the total credits and total debits for that period, and work out the difference between them. This balance is what you'll bring forward as your opening balance in the new accounting period. Whereas, trial balance is usually prepared at the end of an accounting period, for example, monthly, quarterly, or annually, to find and verify the accuracy of the ledger balances before preparing financial statements. In short, opening balance is the amount of money a business starts with at the beginning of the reporting period. Opening balance is the cornerstone of any successful company's approach to forecasting the future. Whereas, closing balance is the balance as of the end of the period you are looking at. Closing balance of any specific financial period is key to analyzing the company's activities and performance over that period of time. Whereas, trial balance was simply a summary of the general ledger to make sure debits and credits balanced. Trial balance is a bookkeeping worksheet in which the balances of all ledgers are compiled into debit and credit account column totals that are equal and have two columns, that is debit and credit. Kindly subscribe my YouTube channel Thesis Helper. Thanks for watching.